So have you ever wondered why your advisor or firm is saying, oh, the returns are good, the returns have been strong for the mutual fund or the portfolio, and yet when you do the math in your head, it just simply doesn't add up? Well, on the last video in our series, You Do Not Know What You Don't Know, is around dollar-weighted returns, or the real net returns that you receive in your investment accounts based on the deposits that you've made and the return that your advisor has captured. And it's staggering that so many people still do not understand that when you have volatility in the markets, meaning that you lose 10%, make 10%, lose 10%, make 10%, that you actually do not stay even. So let me add the math for this. If you have $100,000 and you invest it and you lose 10%, now the math would suggest obviously you lost $10,000. Now a mutual fund or a portfolio would say that would be minus 10. Pretty simple, easy math, no confusion there. But what happens is when that portfolio makes 10% back, and you'll hear this all the time, record day on the TSX or the S&P 500 because of a real surge in pricing, but what they don't realize is that they've lost 20-30% before that, so obviously they're not even close to broken even. And so let's go through that math. So let's take the same $90,000, which is the 90 grand left after the 10% drop, and we're going to add 10% return. Well, 90,000 times 10% is $9,000. So 9,000 plus 90, there's your 99,000. Well, wait a second. If the mutual fund says it had a 0% return, why does my statement say 99,000? And again, let's run through more volatility. Let's go 99,000 times 90%, down we go again, and then we add 10%, and guess what? We've shaved off another percentage point. You do that 5 times within a period of time, you're going to have a 5% lower rate of return just by having that 10% move in the markets to and from. So you're going to have a 5% lower rate of return than if you consider what the time-weighted return was that's reported from all of these banks, mutual fund companies, other institutions that are just reporting numbers in that fashion. And that's at 10%. If you lose 20% of your portfolio, you need 33% just to get back to even. If you lose 50%, which is something that has happened several times in the history of markets, although not that frequently, but it's still prevalent, you need 100% return just to get back to even. So once again, we talk a lot about this risk parity strategy that we have that preserves capital and reduces that real dollar costed average return or that loss. It couldn't be more important as we run through severe stages of volatility probably for the next foreseeable future. Understand what effect that has on your return. Dollar-weighted returns, don't sign up for that. Time-weighted returns, run for the hills. Sign up for dollar-weighted net performance, and if you do not know, ask your advisor to show you what the real dollar-weighted return is, because that is all that matters. You can't spend a hypothetical return. You can only spend the dollars that are in your investment accounts.